Can luxury hotels be serious long-term investments, not just indulgent stays? In India, the answer is turning into strong yes. The domestic hospitality industry is seeing an exceptional period with high occupancy rates of 70% plus. This sector remains significantly underpenetrated compared to other countries. While airlines and travel apps grab most of the attention, two companies in the luxury hospitality space are quietly standing out. Not with hype, but with solid numbers. One, ITC Hotels, now an independent business, post-merger from ITC, and EIH Ltd, the company behind iconic Oberoi and Trident brands. These two legendary hotels are showing strong revenue growth, rising margin and operational consistency. In this video, we break down why these aren't just plays on tourism, but long-term investment opportunities riding India's rising affluence, international business travels to fourth largest economy, premium travel demand and global brand appeal. Hey there, I am Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and India. Please note that I am not a financial advisor. Investing involves risks. Do your own research before investing. Last week I received quite a few comments from our viewers to review different stocks. Thank you for all your comments and participation. Some of these companies are good, but lacked all ingredients needed for long-term investment. So, I have shared my views as a response to the comments instead of including them in a video. Please refer to my responses in the comments pertaining to last video on 4 different companies: VA Tech, CNDLM, Winless Biotech, ICMO Limited. Again, appreciate your active participation and sharing those company names. Without further ado, let us start with ITC Hotels, the hospitality arm of ITC Ltd. Now a spun off into dedicated entity with ITC retaining 40% of the stake. ITC Hotels operate across 4 verticals: ITC Hotels Luxury Flagship Properties, Welcome Hotel Upscale City Hotels, Fortune Hotels Mid-Market Segment, Mementos Experiential Luxury Escapes. ITC Hotels has been pivoting to an asset-light licensing strategy which is delivering outstanding results. ITC Hotels posted 3,333 crores in revenue, up 44% year over year. Profit after tax at 698 crores, up 40%. From valuation standpoint, forward PBI of 54 compares very well to industry or segment PBI of 79. With occupancy rate at 73 to 75% and achieving 30% more premium on revenue per available room compared to industry average, ITC hotel business is demonstrating strong operational leverage. And with more than 60% of its upcoming rooms under management contracts, capital efficient growth is now built into this model. Let us look into why ITC Hotel stands out. 1. Demerger is equal to clearer valuation. Investors can now value the hospitality business on its own terms, not bundled with ITC's cigarettes and FMCG. 2. Brand strength. With the sustainability focused award-winning properties, ITC has built brand equity few hotels chains in India can match. 3. Margin tailwinds. High fixed costs mean that as demand rises, profit rise faster and the margin expansion is already visible. 4. Demand supply gap. India's luxury hotel room supply is growing slowly, but demand is accelerating much faster, especially in tier 1, tier 2 cities. ITC Hotels is doing all the right things to make it a compelling long-term story in India's formalizing and premiumizing hospitality sector. Please note that these are long-term investments. Patient investors can reap significant return in 3 to 5 years period. Recently, the stock has been consolidating in the narrow range for the last 2 months and is a good time to start building positions slowly. Of course, no investment is risk free. Luxury hotels are still cyclical, exposed to demand dips from global slowdowns, pandemics, or geopolitical tension. ITC hotels being newly listed may see volatility as market is trying to still establish the valuations. Now moving on to EIH Limited. EIH is primarily engaged in owning and managing premium luxury hotels and cruises under luxury Oberoi, Trident and Maiden brands in India and internationally. The company is also engaged in flight catering, airport restaurants, project management, and corporate charters. The numbers speak for themselves. In financial year 2025, revenue jumped to over 9% year over year compared to 5.85 achieved by Marriott Hotels internationally. EBITDA margins expanded to 33%, reflecting operational efficiency. What I love about EIH is very high operating margin of 37%. Net profit rose to 751 crores, demonstrating 14% year-over-year growth. From a valuation standpoint, trailing P/E multiple of 31 compared to average P/E of 79 for the sector looks very attractive. This performance is backed by booming domestic tourism, high occupancy rates, and improved average room rates across its portfolio. EIH Ltd has a robust balance sheet, low debt to equity, less than 0.3x, strong cash flows support expansion plans and shareholder payouts. It declared a dividend of rupees 1.25 per share in the financial year 2025. The company is strategically investing in new properties in Goa, Jaipur and Bhutan, renovation of legacy assets like Oberoi New Delhi, and expansion of the Trident brand into tier 1 business hubs. With improving RevPAR and rising inbound tourism, there is potential for earnings growth and positive re-rating. India's luxury hotel market is transforming and the best opportunities might not be in the headlines but in the balance sheets. ITC Hotels gives you scale, brand depth and capital light growth. EIH gives you exclusivity, pricing power and heritage moat. If you are building a portfolio with 3 to 5 year view, these could be two strong compounders riding India's consumption and travel trends. Don't forget to smash the like button and subscribe to the channel. Share this with your friends who can benefit. Thanks for watching. See you in the next episode.